Ladies and gentlemen, and a very warm welcome to the 4th edition of the Money Control Mutual Fund Summit 2025, presented by HDFC Mutual Fund and powered by Axis Mutual Fund. It's a true pleasure to welcome you all this evening to what has become one of the most anticipated gatherings in the mutual fund industry. As Warren Buffett once said, the best investment you can make is in yourself. The more you learn, the more you earn. And tonight, we come together in that very spirit to learn, to exchange ideas, and to gain insights that empower smarter investing and stronger financial futures. Industries don't evolve on their own. They are built by people with purpose. And today, we are surrounded by those very market leaders, fund managers, distributors, policymakers, and investors, all here to shape the future of mutual funds in India. The Indian mutual fund industry has demonstrated remarkable momentum, delivering a 20% CAGR, compounded annual growth rate, in AUM, asset under management, over the last decade, significantly outpacing the 8% CAGR seen in the US. As of May 2025, the industry's AUM has touched an all-time high of 72.2 lakh crores, with 13.3 lakh crores added in just the last year. It's a clear signal of the industry's growing relevance in India's financial ecosystem. Looking ahead, the mutual fund industry is projected to achieve the $1 trillion AUM milestone by 2030. And this isn't just a number, it's a collective vision for deeper participation, broader inclusion, and long-term wealth creation. From small cap and mid-cap strategies to the investment versus consumption debate, Gen Z's growing influence, and the expanding role of SIPs. Tonight, we explore the many forces fueling this $1 trillion dream. Before we proceed, let's take a moment to thank our like-minded partners who've made this evening possible. A heartfelt thanks to our presenting partner, HDFC Mutual Fund, powered by partner Axis Mutual Fund, knowledge partner K Fintech, event partners Motilal Oswal Mutual Fund, Mirae Asset Financial Services, Tata Mutual Fund, and PPFAS Mutual Fund, and associate partner Reliance Industries. Now, to officially open the evening, I invite a thought leader who has consistently championed credible, data-driven storytelling in business journalism. Please join me in welcoming Nalin Mehta, Managing Editor of Money Control and Chief AI Officer, Network 18, for the welcome address. Let's give him a warm round of applause.
Thanks very much, Nandita, and a very good evening to you, ladies and gentlemen. Thanks very much for making the time to come here this evening. The mutual fund industry is at the heart of India's retail investor boom, and I'm delighted to welcome you all to the 4th edition of the Money Control Mutual Fund Summit. At a time when India has just become the world's 4th largest economy, this year's summit theme of the $1 trillion opportunity seeks to unlock solutions on how to scale up this industry from its current size of about $864 billion of assets under management to the next big milestone and its next phase of growth. With India looking to reach its goal of Viksit Bharat by 2047, the mutual fund industry's role is critical for wealth creation, for financial democratization, and for investor consciousness. The numbers show how quickly Bharat's mutual fund industry has transformed India's personal finance story, turning us into a global mutual fund powerhouse. For context, with over 72 lakh crores of assets under management today, compared to 12 lakh crores in 2015, the mutual fund industry has grown at a CAGR of 20% in the last 10 years, as Nandita also pointed out, actually 24% in the last 5 years, in comparison to, say, the US market, which grew by 8% in the last 10 years for mutual funds. We had a record 26,688 crore worth of SIPs coming in last month in May 2025. We now have 9 crore SIP accounts with over 5.4 crore investors, which is 19% more than last year. The geography of India's investing is changing drastically, with just about 1/5 of assets under management now coming from cities beyond the Big 30, which is Tier 2 and Tier 3 towns. So going beyond the traditional centers, we're also seeing huge growth of SIPs from states like Telangana, from states like Uttar Pradesh, and from Haryana. These are all non-traditional centers of personal finance and investing. These numbers are a resounding vote of confidence in the industry, and yet there are big challenges to reflect on. For example, the investor base may have hugely expanded, but only about 5% of Indians currently invest in mutual funds, compared to, say, around 50% of Americans. So as a new generation of Indians become first-time investors and the industry scales up, there are some key issues to reflect upon. How do we build more trust in the system? How do we use technology to increase access without compromising on transparency? And how do we increase investor literacy so that every Indian understands the value of compounding, of risk, and of course, of patience? So our panels today, throughout this evening, explore all of these themes and much more as we deliberate a blueprint for the $1 trillion mutual fund milestone. In the room today, we have some of the industry's best minds, its best fund managers, investors, distributors, and policymakers to deliberate on what next and how to unlock the next phase of investor growth for Bharat, with mutual funds becoming a broader tool for wealth creation and financial security for Indian households. As India's leading business and markets news platform, we at Money Control are delighted to have put together this platform for the industry, and I hope we spark off meaningful conversations, new connections, novel solutions, and long-term engagements that matter for Bharat. Thank you very much, and let's have a great evening.
Thank you, Nalin, for setting the tone for the evening. With that, let's dive into our first panel discussion of the evening. Blueprint for $1 trillion AUM, sustaining investor interest, delivering value. We've all seen how fast the mutual fund industry is growing. But with nearly half of the assets linked to the stock market, the big question is, how do we keep that momentum going in a volatile world? What does it take to keep investors engaged, simplify choices, and still deliver real value? In this discussion, we'll explore how the industry can expand and simplify its product canvas, craft investor-first strategies, strengthen education, and most importantly, build lasting trust. To explore the blueprint for $1 trillion AUM, please put your hands together for N. Mahalakshmi, who will be moderating this session, and also our distinguished panelists, Navneet Munot, MD and CEO, HDFC Asset Management, Radhika Gupta, MD and CEO, Edelweiss Mutual Fund, Kalpen Parekh, MD and CEO, DSP Mutual Fund, and DP Singh, Deputy MD and Joint CEO, SBI Mutual Fund. Also joining us is Nilesh Shah, MD, Kotak Mahindra AMC. ML, the stage is all yours.
Thank you so much, Nandita. It's an absolute delight to sort of kickstart this event with this wonderful panel. I've been a financial journalist for about 25 years now, and many of the people out here have invested all their entire professional life in building this industry that we definitely did not think 25 years ago that could be this sizable, and retail investors would take to this as their primary investment vehicle of choice. So thank you so much, all of you, for joining this. This is especially a meaningful conversation because we are approaching this magical number. Of course, people have already, Kalpen and Radhika have already told me this is, $1 trillion to abhi pahunch hi gaye hain. Of course, pahunch gaye hain. And hoping that the markets are also generous. It'll be here very soon. But what is the next trillion going to look like? What are some of the opportunities? What are some of the course corrections that we need to sort of look at from here on? So I have, in my mind, what I think as 3 constructive points to discuss, and 2 points which are widely debated, I know, within the industry, in the ecosystem. So we'll get some conversation around that. But first thing, let me start with Kalpen because he's been most vocal and consistent in this messaging, that over the last 5 years, and this is perhaps the biggest challenge, that over the past 5 years, our returns in equity markets have been double the long-term average. And this is, you may say it many times, and I think a lot of people are saying it many times, but still, एक पाकिस्तानी poet है जो बोलता है कि दूसरों के कहे से कौन सुनता है, सबको एक हादसा ज़रूरी है. So investors maybe to drill this, by messaging is easier said than done. So how do we get this message across that you've earned twice the return that is possible in this market? Perhaps a little more is possible, at half the volatility, as you put it.
So you start with tough questions to me, so I'll take the bouncer. Yeah, of course, we've been fortunate that disciplined investors earned that 2x return. And what we always tell investors that, why did you earn that 2x return? Because you invested when past 5-year returns were half of the long-term returns. So returns are cyclical, markets fluctuate is the only truth. And all of us collectively have been messaging. In fact, recent ad campaigns by even AMFI have been around highlighting volatility and the need to think long-term. And as you rightly said, universal truth या सत्य एक ही है, उसको 1000 बार अलग-अलग तरह से repeat करना है. I will say it will have effect of 1 unit. Nilesh Bhai will say it will have effect of 100 units, and with Radhika it might be 1000 units. But we will keep saying the same things again and again. And I think another important transition, or maybe migration we need to do is probably talk about rolling returns more often. Talk about what can be the best, what are the worst case returns if you had invested for 10 years, and what are median returns. Right. So that's one way in which education can be done with data points also, apart from the fact that typically the way to educate investors to invest in Indian equities has been around the growth story of India and the fact that we are a democratic country with growth. So that's using the dimension of future growth. And at the same time, we have 30-year history now. And in this 30-year history, we have had cycles of 5 years of zero returns, 10 years of moderate returns. So the more collectively we make those efforts to use factual data, because our industry is also about maths and data and facts. So this balance can help investors. So that direction, if we move towards leveraging more of rolling returns as a communication point versus lowest point to highest point, is one good way to do it. And the second thing I think, which I am happy about is, when both of us were in a company called Prudential ICICI, we had this fund called Equity and Derivative Fund, which has now been repositioned. That category is now a dynamic asset allocation fund or balanced advantage fund. So beautifully, in the last 5-10 years, the industry has grown that asset class extensively. So that asset class auto-adjusts across equity or bonds, depending on valuations and cycles. So in the last 5 years, markets have given a lot of lessons of corrections, though they have been short-lived. So the pain has been temporary. The volatility has been lesser and for a shorter period of time. But these funds have cushioned it a lot more. And a lot of education done around the fact that asset allocation will help you stay put and reduce volatility. These are two things I think we need to continue to communicate, and that is our responsibility. Right. If we just play that role, I think we will continue this growth path. Right.
I like your first point, especially Navneet. As an industry, are we prepared to mutual funds सही के लिए एक disclaimer चाहिए कि क्या aspect सही है, क्या सही नहीं है, because the moment you put rolling return, you're also putting emphasis on the downside, and a lot of people would within the industry would argue, यार अभी तो start हुआ, अभी से तुम disclaimer करना शुरू हो रहे हो.
The difference between our industry and any other product is that there is tremendous amount of emphasis on the disclaimer. If you do a survey across the country, what do you know about the mutual fund? Of course, now after 10 years of hard work by everybody in AMFI, they know one thing, mutual fund sahi hai. But if you ask them, और क्या, तो उनको एक ही याद है. Mutual funds are subject to market risk. Please read the offer document carefully. I think 1 billion people can recite that exactly in the same manner as we put it. I don't think there is any other industry where the disclosures are of the standard that we have. We take huge pride at the same time with a lot of humility that if you compare us with even the developed markets, I think our disclosures are a lot more robust and a lot more frequent in terms of like an investor constantly know what's happening in their portfolio. And that's where like a lot of credit to SEBI and MFI and SEBI. We work together. Mr. Amarjit Singh is here. We work under his guidance. So we take a lot of pride in that. So let me complete. We are also saying that this campaign started in 2017, and I always call this, it's something like pre-suasion. I'm sure you are one of the most well-read journalists in India. This persuasion of Rolf Dobelli. And I keep thinking, this is like what we have done in Mutual Fund Sahi Hai is a pre-suasion. You just kind of like create a curiosity around it that you've been investing like this for not decades, but hundreds of years. Indians have said, we are great savers, but we need to become great investors. You have been investing in a certain manner, but I think you need to look at another product. So what we did was kind of as an industry as a whole. And then it's for all of us together and with the help of advisors and distributors and the people like you, then you do the persuasion, like what is right for you. You are absolutely right, and within the MFI board and our own financial literacy committee, we have been discussing that. Now we need to move to the next level. From Mutual Fund Sahi Hai, we have created that awareness, which was very critical. It's got us like a couple of million more investors into the fold. The next level has to be क्या सही है, कैसे सही है, क्यों सही है. We have been making a lot of efforts over the last couple of years or more so in last couple of quarters, thanks to again a lot of partnerships with people like you. But there's a lot more that I think you are going to see from MFI over the next several years.
I love that word, by the way, persuasion, Robert Cialdini's word, and it's a wonderful concept. DP sir, your thoughts, because your reach is the highest. And to send this message across that Mutual Fund Sahi has been done, how do you make people aware of the risk, the fact that there is volatility, the fact that returns are not going to be as good, and for a lot of small SIP folks that you might be attracting, it is not just about last 5 years. The fact that equities are a volatile asset class itself may be a new concept.
No, first thing first, I absolutely echo what Navneet has said. The pursuance and the way the whole industry is working is something which is very important. And recently we in our fund house, we have come out with a website, mutualfundqsahihai.com. Okay, that is there on this thing, and we say mfqsahihai.com. And kya sahi hai, kyun sahi hai, exactly what you are saying, that is more important. And at the industry level also we are doing it, at individual level our player we are doing it. But this is extremely important going forward when people have seen such a good return over the last 5 years, 10 years. So it's our responsibility to take the message along at every nook and corner of the country. Even we have published under the investor education do's and don'ts for the investors. We are publishing that, we are putting the posters all across the country in distributor's office. Of course, when we discuss in MFI board meeting and all those things, it's not only the industry, industry body who has to do it, individual fund houses also have to do it. And we feel that especially when we talk about SBI branches, which are there, so we feel that that's one thing where we have to put posters. We have put thousands and lakhs of posters, do's and don'ts for the investors. We have put the posters in the branches so that there is no mis-selling, there's no concept of, any misinformation, especially going forward, what all we can do. So those are some of the subjects we all, as an industry as well as individual fund housing, we are doing it. But this is extremely important. And actually, when your auditor was talking about the 2015, the whole industry was 12 lakh crores, and today it is 72 lakh crores. I was just wondering that today we are 12 lakh crores as a fund house only, and when the industry for 10 years ago, so I was thinking, is it possible that 10 years again, after 10 years, will be 72 lakh crores or not? So that is the kind of growth we can see it. And we're looking for a period when, today we are talking about deposit to, AUM to deposit ratio. But I think next 5 years, 10 years, it will be other way around. People will be talking deposit to AUM ratio.
Right.
That's what we are looking for.
Right, true. So quickly moving on to a slightly larger canvas. 50% of the total mutual fund in AUM, roughly, is tied to equities, right? Now, because this money is gushing fast, of course, I don't know whether we should say fortunately, unfortunately, the SIP flows, total number accretion is going down. But otherwise, because of this flows, we've talked about this, there is this bubble that gets created, especially in segments that are, momentum driven and so on. And mutual fund industry as such has really proven its worth in terms of transparency, like Navneet pointed out, disclosure norms, it's very cost efficient, all the virtues of, liquidity, all of that is sorted. So we have a great framework. What do you think can be done or should be done to take the product canvas beyond equity and debt? Because the essence of investing safely is about diversification.
So thank you Mahalakshmi for having me here. And DP भाई, तू ये 72 लाख की बात मत कर, ये $1 ट्रिलियन तो हमने तेरे लिए ही छोड़ा है, तो तू 88 लाख करोड़ कर देना, बाकी फिर हम लोग थोड़ा काम कर लेंगे. Now, how do we expand industry? So first of all, I have to convince all these ladies and gentlemen sitting over here that if you keep currency notes at home, it will not grow. Collectively, they have 35 lakh crore plus currency notes at home. The total amount invested in mutual fund, excluding mark to market, will be less than that. And our returns, as Kalpen mentioned, is 12, 15, 16, 20%, whichever number you like. तो मुझे तो इन लोगों को कन्विंस करना है कि भैया घर पे पैसा रखेंगे, उसके जार्ड नहीं उगेंगे, म्यूचुअल फंड में डाल दो, थोड़ा ऊपर नीचे होगा बट पैसा बनेगा. इट्स सच अ डिफिकल्ट टास्क. रिटर्न पे रिटर्न दे रहे हैं इतने सालों से, बट ये लोग पैसा रिलीज नहीं करते. सेकंड, ऐसा नहीं है कि इंडियन इन्वेस्टर्स आर लाइक दिस. I can go to Japan and show them the return they have made in Indian equity. And the return they are making in their equity or their fixed income. Undoubtedly, they should be putting more money over here. So one is to expand the investor base. Today, there are 30 crore plus vehicle owners in India. The number of investors in mutual fund is 5.5 crore. Ideally, every vehicle owner should be a mutual fund investor. So I still have to grow 6 times more. But convince karna baki hai, Mr. Mendes. The second thing is in terms of product. Clearly, as of today, we have products across equity, fixed income, and precious metal. But can we expand this into many other products? Thanks to SEBI, we are slowly and steadily moving into that. So REIT InvIT is coming, performing credit in AIF is coming. But any product which is bordering on the debt side will require rule of law. Return of principal is more important than return on principal. And in India, if you are stuck in ILFS, you never know when the principal will get returned. So we need rule of law so that we can create structure between debt to equity, between lower risk to higher risk, and hopefully over a period of time, we will have enough product to meet different risk return requirement of investors. The third will be geographical expansion. Today, whether we like it or not, we are still mainly urban India phenomena. Undoubtedly, semi-urban and rural India, we have penetrated, but there is far bigger scope. So how do we create channel whereby we can go to different geography? So either we'll have to expand investor base, or we'll have to expand geographies, and we'll have to expand product. Combination of that three will ensure that whatever DP Bhai creates, we'll also be able to create as an industry.
No, my question was slightly different. Of course, you're talking about investor growth and growing the size of the industry, getting more investors invested in the mutual. I'm asking that right now, this framework has only two broad asset classes, which is equity and debt. There is real estate, there is commodities, there is a lot more which offers diversification. I'm asking this question because In India, we have always narrated this line that, in the long term, and I think it's, I don't know if it's narrated as often in other countries, we don't know, that equities are the best asset class over long terms. And it's not necessarily true, because the champion of this line is only the United States. You look at Japan, 20 years, no return. Last 10 years, no return in China. Brazil, long periods, no return. Russia, no return. So there are several examples in the world to show that long-term equities need not be the best asset class. In many countries in Europe, debt has been maybe a couple of notches below. Real estate has been on par or better. So how do we take this fantastic, efficient framework to cover other asset classes to be able to give a safer, a better milieu of products to investors?
So we have on precious metal, gold and silver products. Could I be going into other commodities? But we need rule of law there for me to participate. Otherwise, I'll end up creating national spot exchange equivalent phenomena. The commodity markets, either the arbitrage is very, very low, the returns are poor, or there is no security. In terms of real estate, again, do I have ability to manage REIT? Answer is yes. And we have gone to SEBI to increase exposure to REIT, InvIT, and they are actively considering it. But can I be running a real estate project? To a builder, it is 20, 30, 40% IRR. But we have seen experience of all the foreign capital which came into real estate investment over last 20 years. They have barely delivered better return than savings bank account. So one, we need rule of law so that institutional capital can flow. We need to attract talent. And then we need regulation which will support that kind of product creation. Can it all happen tomorrow? Answer is no. Will it happen over next 5, 6, 7, 10 years? Answer is yes.
Sure. Radhika, you are a relatively young fund house, and usually all these, things really, new ideas really come from the periphery, the newer, younger players, and they sort of come and disrupt and create a whole new game. How geared up do you think are the, relatively smaller, younger players in the mutual fund industry to drive something like this?
I'll answer that, and thank you for having me here. But, newer fund houses are often called innovative, etc. And this word in the context of innovation, and I'll also just plug into what Nilesh Bhai said, has always thoda sa scared me. India has today a lot of asset classes. You have equity, you have debt, you have gold, you have silver. You want to do bronze arbitrage, you can sit and go do that. You have SME, IPO. You have actually no shortage of asset classes today in India. Net, you still have 5 crore investors in the country. I genuinely believe our job is market expansion. Now, the other thing you have to realize is India is a very nuanced consumer market. You have treasuries and family offices with 1,000 crore corpus who can happily, who have a 10, 20-year risk appetite, who can absolutely put money into REIT and all this stuff. And you have people who are making their first 100 rupee SIP who don't even realize कि अगर मैं equity में पैसा डालूंगा मेरा return कितना होना चाहिए. That is the cross spectrum of consumer that we deal with. And I think you have to build you have to build products for consumers. So today in India, I think for 90% of consumers, actually equity and debt is just right. It is dal and chawal for a population that is not very, very nourished. And why should you confuse anybody with anything else? Dal chawal for the next 10, 20 years is actually good enough. For the next bracket of investors, by the way, SEBI has created something called specialized investment funds. Some of us have got licenses and are launching products. I'm sure many of them will. So for a 10 lakh consumer, we are giving dal chawal with some tadka, some ability to do derivatives. For a 1 crore consumer, SEBI has created AIFs where you have venture capital funds, SME, private credit, you have everything. So for different life stages, we are actually building diets. So I think, we have to be a little more nuanced about that. As far as innovation, I think innovation in any industry has come from outside, but I think innovation has to be deeply purposeful. I'll speak about two sensible pieces of innovation, one that came from our fund house and one from another one. The whole balanced advantage fund category is not very, very complicated, but I think it's an incredible innovation that came from a fund house that catered to the need of an Indian consumer. I think Bharat Bond ETF, in the way it's scaled, the whole concept of target maturity fund, FD in a tax efficient format is very sensible innovation. And the third most sensible innovation that has outclipped the word mutual fund is what? It's not even a product. It's called SIP. It's a feature. It caters to the savings need of Indians. So we are innovative, but we are innovative with a purpose.
Sure. So my question was only because of the sense of risk perception related to equities, which I don't know if all of you agree.
But you know,
the
one
global
thing,
market.
if I can just add thing, I don't know if to change the, at least when someone invests in equity, they understand what they're investing in. They see the Indian economy. They see the growth of companies. They see companies listing on the exchanges. I don't know if by buying an ETF that Nilesh Bhai is long oil and short copper, you're actually creating a product that is better for the consumer.
By the way, till few years back, Mahalakshmi, in any of these events, and both Nilesh Bhai and I, we were the bond fund manager, the biggest criticism of our industry were two. And Mr. Singh is here, he has seen our journey over the years, and a lot of time we'll have somebody senior from SEBI coming in, a lot of other people like you. And the biggest criticism were two. Number one, your industry does not have as much individual participation. Most of your money is institutional. Number two, your industry thrives on fixed income money. You guys don't have still the equity penetration. This is only in last 6-7 years where we have seen equity flows of this order. Our SIP book, after 20-30 years of hard work, only reached 4,000 crores in 2017 first time, which has become now 26,600. But I think this is just beginning, because if you look at the overall household balance sheet in India, the equity allocation is still less than 5%. Equity allocation is still less than 5%. So our worry should be that how are people going to secure their retirement if the participation in the growth of the country is that less by a large number of people. And a Viksit Bharat, unless it is equitable and inclusive, then it won't really be Viksit. And that's where the role of the capital market and providing that growth opportunity to at the population scale. The other thing I'll mention just to add to what Radhika and Nilesh Bhai. So if you look at our growth, so we have become $800+ billion, we'll be $1 trillion for sure. Just to put this number in perspective. This is where US was in 1988 or so, you can check. And by the end of 2000, they were $5 trillion. And you can see a lot of other parallels between what happened in US and what's happening in India. Now I won't get into that detail. But I think your point is very valid that, and the reason for our success from 100 billion to 800, the things that have helped us, apart from the track record that Kalpin talked about, apart from transparency, apart from the training effort that we have put in place, apart from technology, the other way to look at the macro factors is basically the formalization of the economy. It's the digitalization of the economy. It's digitalization of finance. It's financialization of savings. Some of these are talked about quite a bit. The thing which is not talked about, which you will see in next 20-30 years, is the financialization of assets, because that's where the large part of the investments are. When I see a Blackstone CEO coming here, a Brookfield CEO coming here, and saying that we'll double our investments from $50 billion to $100 billion in next couple of years, and I keep thinking that why are roads, transmission lines, data centers, commercial real estate, so on and so forth, is owned by teachers in Quebec or let's say the firemen in Australia? Why are Indians not owning it? I think it is going to happen. The fractionalization of assets, and I think mutual fund is a wonderful vehicle. We have shown this over the last several decades. I think over a period of time, we will have a role to play. As the REITs markets, InvITs market develop, I think our ability to provide that solution to investors, I would say stable returns by owning a hard physical asset in a country of like our kind in terms of rule of law, in terms of policy and all of those things would be phenomenal over the next several decades. It's just a matter of time.
Fair enough. Now, on that note, I'll quickly get into a territory which is highly debated, DP sir. There is this categorization that is allowed by SEBI in both equity and debt, 16 categories, equity, hybrid together, and 16 category of funds within debt. And despite that, we have about 40, 44, I don't know what's the exact number now of AMCs. We have about 1,880 fund schemes. Now, on any given day, the daily average number of stocks traded on NSE is about 2,000 to 2,200. Now, the problem of selecting a fund seems to be far bigger than the problem of selecting stocks. Now, on one hand, we are saying investor awareness and literacy and stuff like that, and we are making this whole thing so complicated. And it also sounds like a hypocrisy of sorts that you have categories, and yet, there is no cap on the number of mutual fund schemes a asset management company can have.
See, we have got only 50 fund houses, and as SEBI is making it easier to more and more fund houses to come, I think 1,800 can be 3,000 also. That's one thing, because categories, they are large cap stocks. As you said, only 2,000 stocks. Yes, 2,000 stocks, but if you go through the mutual fund portfolios, I don't think all fund houses put together will be more than 600, 700 stocks. Okay? I think universe is common, right? 400, when anybody will be having a universe of 200, 300 to say 400 to 500. But 700, 800 will be the total stocks which will be there. So, having said so, we
तो आप क्या बोल रहे हैं मतलब कि लोग स्टॉक ही खरीदने फिर
I'm coming to
फंड
that.
तो
I'm coming to that. See, when the categorization was done, it was done very, very, with a lot of discussions, lot of consultations with the people. And the industry has grown so much. As you were saying, today our equity, AUM is more than 2.5 times than what the whole industry was 10 years ago. So when the funds are going so much, and if you look at the in other countries, and developed countries also, every fund house will have so many schemes. Now they are having so many ETFs, so many schemes. But investors have also evolved, and see, today number of schemes are more because of so many thematic funds have come, so many sectoral funds have come. Whenever there is a bull run in the market, people go to the micro sectors and some schemes like defense sector, this sector, that sector. So number of schemes have gone up. But if you look at it, the overall, all put together, the maximum AUM, 70 to 80% AUM will be 5 or 6 categories. So that is, we have to see, and that, it's not that the whole AUM is in so many sectors. If you talk large cap, mid cap, large and mid cap category, focus category, and small cap, if you all put together, I think the 80% of the AUMs will go there.
No, fair point. But from an investor's perspective, the problem of selection, is that not a real problem? Is that not a no?
Do you order from Swiggy, Zomato? Never.
I do. Why?
I mean, there are like
that's
thousands of items. I know that. So this morning my wife is traveling, and I was in a hurry to go to office, and I ordered like a chayos ka chai plus the poha because I only needed that. It doesn't matter like where lots of other things might have been there, and they will always pop up like 7 other things. If like it was a little more complicated other than that, let's say the same thing about the medicines, right? But then I'll have an advisor, just like a doctor, I'll go to them and they will prescribe me.
You are trivializing the point. I mean, you can't compare financial
क्या
investments of a lifetime with ordering on Swiggy, Navneet.
No, all I'm saying is it depends on the investor, because if there are 50 AMCs, you'll have 50 large cap fund, right? This has only happened in India. And again, maybe I won't get tired like praising SEBI for what they have done. I just hope at some stage ICI in US, Investment Company Institute, does a paper that there is so much we can learn from India. There's no country where you have this kind of classification. All of us can only have one large cap, can have one flexi cap, can have whatever one. And within that, what is large cap, top 100, whatever, next 50. You go to US, somebody will say mid cap 5 billion, somebody will say mid cap 20 billion. There is no standardization. Everybody has got S&P 500, and I keep thinking, Cathy Wood's fund versus somebody else's fund, somebody value, somebody invests only in REITs and whatever. In SEBI, like you have a proper benchmark. So I think that way with the classification, with the uniform benchmarks and the amount of information and all, I don't think like we have reached a stage where people are spoiled for choice unless others have a different view.
But are you, Radhika, truly worried about, narrow thematic funds like, tourism fund, defense fund, EV fund, and, we also take refuge in the fact that, passives are no risk. So what are your thoughts?
Okay, I have a related but slightly different view. And this discussion on too many categories, too many funds, ये काफी हो चुका है. It is also important to be a little solution oriented. Now we've had a lot of food analogies, but it's my son's birthday today and he plays with lots of little Lego pieces. I think as an industry, we have created a lot of funds, a lot of categories, all the individual pieces of Lego are there. We've done mutual fund sahi hai, we've established trust. I think what we perhaps now need to do, and I learned this writing our book, is explain kaun sa mutual fund kaise sahi hai. I think step 2 of mutual fund sahi hai is kaun sa mutual fund kaise sahi hai. For instance, if we have 45 categories of equity funds, to DP's point, there is a core category of funds, and maybe as an industry we need to now talk about these are the Lego pieces. Here are recipe books or here are guidebooks on how you put them together. This is your core category of funds. Yes, there are 30 thematic funds, including tourism fund and future of transport fund, but these are all satellite category of funds. These are gardens. They're not the main Lego blocks. We attempted to do this in Mango Millionaire. We actually attempted, and it was so difficult. The hardest chapter I wrote in a book on personal finance was the chapter on mutual funds, because it was very, very hard to try and break down what was core and essential to everybody and what was satellite and not essential. So I think perhaps now we need to talk about how to build with the Lego pieces.
Okay. Fantastic point, and I have a point related to that, which is, now we have this special investment fund category, which is over 10 lakh, right? Now, because I'm presuming that everybody is on the same page with the fact that, narrow thematic funds are essentially, should be seen as high-risk funds and should be well understood. It's not like for a mass market product. Why not put those satellites into this SIF category? Just because they are plain vanilla, don't use derivatives, doesn't make them less risky. So why should they be under this, mutual fund category at all? They should be in SIF category. What are your thoughts?
I was just looking at chair there. Amarjit Bhai is there.
Yeah.
Whatever he says, we'll do it.
What are your thoughts, Kalpit?
अमरजीत भाई जब आप बाहर गए थे तो इन्होंने पूछा कि थीमेटिक फंड्स रिस्की फंड्स है, उसको आप एसआईएफ में क्यों नहीं डालते? मैंने बोला जो साहब बोलेंगे हम करेंगे.
Yeah, I think we've moved from few funds to plenty of funds, and in evolution it's happened. Personally, my view is there has to be a slightly better nuance, better balance, and we have to bring in better responsibility of also launching thematic funds with guardrails, even timing them, because many times we also know that we as human beings mistime our investments by buying the theme at the wrong time. So at least we found the middle path to say that, and I'll tell you why. Like ideally, I would love to do what PPFA has done, just one fund and build very large. But our investors have different choices, different levels of understandings, needs at different points in time. So how do we think of that balance? That bring thematic funds. So we try to have this very crude, intuitive way. Will we put our own money in that fund when we do an NFO of a thematic fund? If the answer is yes, we are happy to launch that. If the answer is no, we'll not launch that. At times when returns are very high. We had, like I remember at some point in time, our natural resources fund had 40% CAGR, and it was investing in energy and metal stocks. So we stopped taking money. On our website, we put a huge disclaimer in black and red, saying that, this is thematic, not suitable, take appropriate advice. So I think choice sometimes becomes confusing, but there are ways to solve by educating better and by transparently highlighting what could be the risk. But at low cycle, sometimes some of these thematic funds can actually deliver very superior return for a more sophisticated investor. And this is a good, interesting point you've said, that could they be a part of SIF? Maybe it's a good thought to debate and evaluate.
But just one point, taking market call is not as easy. Navneet Bhai ने defense fund launch किया, पैसा ज़्यादा आ गया तो उन्होंने सब्सक्रिप्शन बंद कर दिया, SIP कर दी। मैं सोचा नवनीत तो बहुत स्मार्ट आदमी है, अगर वो बोलता है डिफेंस एक्सपेंसिव है मत लॉन्च करो। नाउ आई एम रिग्रेटिंग, इट इज़ द बेस्ट परफॉर्मिंग फंड। तो मार्केट कॉल लेना उतना ईजी नहीं है।
Even the SIPs are closed for over a year now. It's probably the only open-ended fund where you cannot put any money even in the form of SIP for last 1 year. I think all of us have that sense of responsibility on us.
No question about that. So that's all we have time for, so we'll have to wrap it up. Thank you so much, the lady and gentlemen, for this.
Thank you, everyone, for such an insightful, engaging, and interesting discussion. Well, now it's time for a very special segment, a keynote address that reflects the regulatory vision shaping the future of India's mutual fund industry. In a fast-growing space like this, it's not just about scale, it's also about growing the right way. Balancing innovation with investor protection and speed with transparency is key to building lasting trust. As mutual funds become the preferred savings choice for millions, the regulator's role is more critical than ever. But so is fostering self-regulation and an investor-first culture, from fair dealing practices to suitable product design. To share insights on where we stand today and the road ahead, please welcome Amarjeet Singh, whole-time member, SEBI. Let's give him a big round of applause. Good afternoon, sir.
Yeah, good evening. It's indeed a pleasure to be here. In fact, I thought Mahalakshmi would allow a couple of questions to the panel and I would ask a question, but that opportunity was not there. So, I know. No, the question that I wanted to ask was, I'm digressing from what I have to speak. So see, as a regulator in India, you can see my brain in two parts. One part relates to development of the market, and one is very happy to see the growth. And one part is that of a regulator, which worries, and we are paid to worry, we are paid to spoil the party, if I can say, or at least caution the people that, look, we are trained to think more in terms of risks. So the question I had in mind was that while we are growing at a fantastic speed, and it's a phenomenal growth, it's a huge success story, and there was a discussion around there's a need to expand more. There's a huge potential to get more money into the mutual fund category. What worries me is that, not a worry, what we need to be watchful about is, do you have enough investment opportunities? Do you have enough, asset classes to invest in? Is too much money chasing too few good opportunities? So there are no easy answers to it. Thankfully, we seem to have a good primary market, good pipeline of IPOs coming in and so on. But I guess the speed at which money is coming in, we'll also have to work, and in that sense, mutual funds also have a stake in ensuring that there are more investment opportunities in the market where, money can be invested in a very productive manner. Anyway, I think let me come to my presentation. So in fact, when Mahalakshmi reached out to me that I should come for this event this year also, So I was a little reluctant. I said, look, I don't have much to tell you all. You guys know everything, and what value can I add? But then, we were discussing, and we said, okay, as a regulator, while we celebrate the growth story, I could maybe talk about growing the right way. And what is that right way in terms of growing? Basically, just putting a word of caution here and there. And also, I've been personally, and Navneet knows about it, fascinated about the discussion on culture and ethics. So, and I feel that part is often under-discussed in our ecosystem, while we definitely talk about the growth story, success story, and so on. But what is the, role, a good culture and ethical framework in the industry? How, if we strengthen that, we would probably be growing the right way. That's, in a nutshell, what I wanted to talk about today. So let me just move on. So what I would cover is the growth story, which you all are familiar with. By the way, on the growth story, again, when I joined SEBI, that was 30 years, more than 30 years ago. So that time, everything was very new for all of us in the system. And one vision that we had even at that point of time was, how do we create equity culture in the country? And we had some examples of well-developed markets. And actually two, I would say, two routes that we very consciously chose at that point of time was, we'll encourage individual investors to come to the market through mutual funds. And we'll also encourage individual investors to participate in the IPO market so that they get a sense of how the markets work, what is the prospectus, how do you invest, and so on. The caption of your summit today, that reaching $1 trillion dream, it was actually a dream. It was a very distant dream for us at that point of time. And by that point of time, even years later, we had not thought of such numbers. So it's very gratifying for me professionally and personally to see that vision is getting fructified in terms of when I see the reach, the depth our market has achieved in the recent years, the way mutual fund industry has grown is very gratifying. And I'm happy it is happening before I superannuate from SEBI. So in some sense, it's good to see how, and also let me also mention that we are one of the unique markets where regulators have very closely worked, especially in this segment. We worked very closely with MFI to chart out the growth path of the industry. So, as I said, growth story is known, but I'll show you some slides on that. Growing the right and responsible way, there are many, many dimensions to it, but in the interest of time, I'll talk only about what is the context in which growing the right and responsible way becomes very important, and that context is increasing democratization of the market, and I'll talk a little bit about that. Then the one important theme was how we can focus on strengthening ethical behavior in the industry by focusing on culture and ethics issues. And also want to touch upon the way we work with MFI and how we can make it even better in terms of outcome-based, collaborative regulation, and some takeaways in the end. So the growth story. 72 lakh crore AUM in May 2025, which used to be 8.25 in 2014. I mean, figures speak for themselves. I don't have to say much. 9-fold increase in a period of 11 years, which is fantastic. So this is, a snapshot of the journey so far. Roughly about 10 years ago, 2015, 16, 14, that period, You had 810 schemes, of course, as you rightly pointed out, there's too much to handle for investors, perhaps, and we are looking at that. 3,000 crore SIP inflows, which are today almost $3 billion, 26,688. So that was what I was referring to. So much money coming in, and all sorts of negative news very easily or very quickly gets factored in, and there's no stoppage there, which is good. I'm not saying it should not happen. It's good. We need more and more people to come and participate in the market. But we need to also look at expanding the investment opportunities. Share of B30 to total AUM from 9% to 18%. Share of retail to total AUM, again, 23% to 28%. Number of distributors has gone up from 70,000 to 2 lakhs. And number of folios also today is 23 crores odd, which used to be 4 crores. What are the key drivers? Key drivers are use of technology, onboarding, transacting, and customer service. Buoyant markets, of course. Regulatory reforms, and I'll talk about that, and a strong focus on investor education. Another important data point here, this is flow of financial assets of Indian households. So in terms of the flow in 2013, the deposits, the bank deposits, NBFCs and other deposits, out of 100 rupees, 57 rupees would go to deposits, which has now come down to 37.2. Mind you, it is the flow, it is not the distribution. And look at the mutual funds, 0.8, and now it is 6.1. Again, there's a tremendous potential. There's a lot of runway for this number to grow. Now let's talk about the next segment of my presentation, growing the right and responsible way. What is the context? So growing the right and responsible way becomes very important when we as a regulator are focusing on increasing democratization of the market. More and more people are coming in, they are, trusting mutual funds with their money, and that trust is very important, and that should not get disturbed. And I wanted to take you through how, and this is again unique to us, how as a regulator, as a part of our developmental function, how we have very consciously worked towards the growth of this segment of the securities market. So we started with reservation of shares for mutual funds in IPOs, which has continued till date. We created certain percentage for them as a part of anchor investor category. And also in public, we created certain reservations for mutual funds. We introduced B15 incentives in 2012, B30 in 2018. Micro SIP is the latest edition, and I guess we need to do more here. This 250 rupees SIP. And I don't like to call it choti SIP. I hear that term often, but I believe we should not, calling it choti, we should not belittle it. It's very important segment of our target savers. So micro SIP, 885 registrations. I believe we can do much more here, and I hope we'll see more traction. Investor education by AMC, setting aside of 2 bips. Education by AMFI, SEBI, cap on total expense ratio. A very closely regulated market to protect the interest of investors in mutual funds. All this has actually led to increasing democratization of the market. What are the key underpinnings of responsible growth? It's very simple, and we hear these terms very often: trust, transparency, and accountability. If we have these 3 things in place, this will lead to responsible growth, which will further lead to more democratization of the market. I had a meeting, very interesting meeting with some distributors recently, and one of the distributors told me her story as to how she got, and I'm sure you have many more stories to tell, but this is just one example. So she told me, and I was quite impressed. I said, why don't you share this? This could be a case study sort of thing. Why don't you share the story with me? So she sent me a 2-pager on this. So she came across this very low-skilled worker who used to go to people's houses, house to house, and he was basically a massage person. He'll go and do massage of the people. And this distributor was actually visiting the client where this massage fellow was there. And he saw her advising the client, and then, he reached out to her separately outside the house, can you help me also? And she said, yes, why don't you start a SIP? And he started a SIP. He was a resident of slum area. He started 3 SIPs of 1,000 in 2007, which I'm sure he increased, added more to it. He also invested small lump sum savings every 3 to 6 months. In a nutshell, what he invested since 2007 was 53.4 lakhs. Not a small amount, but I'm sure it grew over time. Current value is 2 crores, unrealized gains 1.56 crores. Overall, IRR is 14.63, number of folios, this data is there. So this is a testimony, and I'm sure there are many more success stories like this. This is the real democratization. And today this person is supporting education of girl children in his native village. So I think it's, in fact, I was telling the distributor, you should go out and share this. She told it much better than I'm telling you. She told it with such passion that I was, really impressed. So success factors are responsible guidance, professional, and see, he entrusted her. He didn't know anything about the market. He simply entrusted her with the, with his money. So responsible guidance, professional fund management, discipline investing, and power, everything has come together to make the success story. Now, let's talk about what do you mean by growing the right and responsible way. As a regulator, we can only go up to a point. When we can create frameworks, we can create do's and don'ts, we can create penal provisions and so on. But when it comes to some misconduct which happens on the ground, we are not there. And in that sense, our job becomes post facto reactive, and you can't help it. So we can go up to a point. What we need is, while we grow, while we celebrate, we should also focus on effective self-regulation. And that's what we are trying to do with MFI. That's where culture and ethics becomes important. Effective gatekeeping, role of auditors, internal and statutory, role of AMC boards, role of board committees, role of trustees, all this is very important. And outcome-based collaborative. Today I want to focus more on culture and ethics and maybe a little bit about outcome-based collaborative, what I mean by that. So the ethical behavior, how do we strengthen that? There are very good players in the market. I'm not at all trying to suggest that it's a huge issue, it's a huge market failure issue. No, it is not. I'm just trying to suggest that while we grow, let's also continue to strengthen our systems so that there are no accidents. There's no loss of trust of investors who are reposing faith in the industry. So culture is a very abstract, amorphous terms. It means different things to different people, but we need to break it down. What exactly does it mean, especially in the context of the mutual fund industry? Generally, it is referred to the way of doing things, it drives conduct, it shapes decisions and actions at every level. And also, culture, sometimes it gets confused that you have a good value statement running into number of pages and people sign on it, some codes of conduct, but that does not necessarily ensure that that is the culture of the organization. Culture of the organization is, what is the core of it? What employees view as acceptable behavior. You may have reams of paper, but there could be a huge disconnect between what is practiced and what is preached. So in that sense, it's very important to identify that point. But if you ask me personally, if I can describe just in one line, it is doing the right thing in the right manner. So, if you're just conscious of that, I'm doing the right thing and I'm doing it in the right manner. So both ends and means are sort of taken care. And very often, we've seen so many scams and crises world over, even the global financial crisis. If you ask me, if you drill down deeper into the reasons for global financial crisis, you will probably identify that it was a huge ethical failure on part of the people who were selling those, the products which were designed to harm the investors, which were missold to investors and caused huge losses to investors. But very often, as it happens, we shoot the messenger, but we don't address the root cause. There was very little discussion on the ethical failures or on the ethical dimensions of the crisis. A lot of other reforms happened. So root cause often is ethical issues, ethical culture, which is not much talked about. And key to ensuring that investor interests are prioritized over short-term gains could be just one guidepost as a part of the culture the AMCs and the distributors and the rest of the stakeholders would like to emphasize. Challenges to ethical culture. Why does ethical lapses happen? See, there are competitive pressures in an AMC. There could be 5 fund managers. Each fund manager may be competing with each other to show better performance. There's a competition internal, apart from the external competition. Growth pressure. Everybody wants to be in the top 10 AMCs. I want to grow my AUM, come what may. Do whatever is, if others are doing something wrong, you can also do it, but grow your AUM. I'm just generalizing. Pressure to deliver returns. I have to give returns to investors. Even if I have to fudge, I will not mind. Again, exaggerating. And also sometimes there is a fear from the regulatory scrutiny. What if I'm caught? Let me hide this. Let me hide it as much as I can. Over the years, if it gets exposed, it gets exposed. I'll not reveal it today. So I do some putting things under the carpet and so on. Just a cartoon to show this is a desert, very dry place, and the water bottle is being sold at 100 euros per bottle. And the discussion about who are selling it is unethical, but fortunately from a business ethics perspective, it is ethical. That's how you justify, you rationalize something which is, unethical at the core. Again, another cartoon just to sort of make the point. So I'm not sure if you can read this here. This is a corporate office setting, and they are discussing a complicated issue. So what is stated here is, it's a complicated issue, but I think we should take the financial high ground. And what is not stated here is there is a moral high ground and there is a financial high ground. And you choose the financial high ground. Moral high ground can wait. Let me give you another case study of Wells Fargo. Many of you would know it's a bank, financial institution, very big bank in US. And, a lot of mis-selling, cross-selling happened. Let's look at some details. It was unscathed during the financial crisis, global financial crisis, but huge scandal which came out in 2016. Over 3 million unauthorized bank accounts were created. 565,000 unauthorized credit card accounts. Basically, you will cross-sell a product to an existing customer without, whether the customer needs it or not is not the issue. You have the targets, you're at the branch level, and you need to increase the business for the branch. And we see it happening in our system also. We get so many marketing calls, and your number is picked up from various data banks. Forged signatures, false records. It's a long, there's a Harvard Business Review has done, Harvard School has actually done a case study on this. You can see the details, and it's very interesting. 5,300 plus employees terminated. CEO resigned. CEO defended the behavior, but he eventually had to resign under tremendous pressure. Billions of dollars were paid in fines, penalties, and settlements. And of course, it impacted the reputation of the bank. Now let's look at this Wells Fargo story. You know, if you read their culture and value statement, it's fantastic. They say the same words. We believe in doing the right thing. We believe in doing things in the right manner. We will not compromise on this. Business can wait. All that is mentioned. But in practice, things go stray. So leadership actually promoted aggressive sales goals. Incentive structures, sales quotas and bonuses were linked to cross-selling of products. Team-level culture, there was a fear, retaliation, and misconduct was somewhat normalized. Risk management, again, prioritization of business over risk and controls, and overall broader governance and oversight, board failed to maintain that. So, this is a sort of, I thought it's a good case study because things are going well, bank is growing, but what is, not known, what is the real story behind that growth? Sometimes, we need to understand that. So what are the characteristics of ethical culture? It's definitely ethical leadership. You set the tone at the top. You need accountability, organization, right from the junior level to the senior level, reporting mechanisms, appraisal systems, and so on. And it has to be, it's not just one person. When things go wrong, it's the whole organization which suffers. Robust governance frameworks which are required at various levels, right from the board to the lower level. Transparency. See, it's one thing to talk about we are a very ethical organization, but what is the transparency around the ethical practices that you practice? My culture and value statement can be just like Wells Fargo. But what is the transparency? And also, if I can point out, if there is evidence around ethical practices, regulators can breathe easy. Regulators can move more to a principle-based regime than a rule-based regime. Speak-up culture, do you allow, if something wrong is being noticed, can that person really speak up? And if he speaks up, will he be protected? Do you have that sort of framework, whistleblowing, and so on? Another point, alignment of incentives with ethical behavior. Or do you reward ethical behavior? Do you recognize ethical behavior? Very important. So, as we saw in the Wells Fargo case, again, I'm going back to that, incentives are more on business expansion than the ethical practices. Education and training on ethics, we never talk about this. In fact, I've been telling Navneet also, let's do a conference on ethics only. And you have a good, AMFI took a very good initiative of ethics committee. So as I said, not that our house is on fire, but the point is we need to bring these issues front and center so that enough guardrails are built from within the system where regulators also doesn't have to do much. This is all part of self-regulation. Now the last piece of my presentation, so towards outcome-based, collaborative, sorry, it's a little longish technical sort of phrase here. So what I mean by this is that what truly matters is the investor outcomes and market integrity. We want to work very closely. We've been working very closely with AMFI and we want to strengthen that further. That is collaborative regulation and we want to focus on outcomes. And the outcomes are not just that you are ticking the box. Compliance is just one important piece, but what matters is the investor outcomes and market integrity. And this can be built only when we trust each other. The stakeholders have faith in each other. What are the advantages? If I do something without consulting AMFI, I may come up with a rule which is not very practical. Because AMFI or the industry players are more familiar with the ground realities, and that is why the need for collaboration. And as some of you know, we've been very closely engaging on any important policy initiative with the industry. So this actually collaboration with the regulator brings us on the same page in terms of what is the purpose, what is it that we are trying to achieve, and it also builds a feedback loop. Wherever we are, maybe overdoing or underdoing, its industry tells us that, look, this is a place where you're going too far and you should not be doing this, and we'll listen to them. Eventually we'll decide, but we do listen to them. It also provides opportunities for simplification, like you mentioned about too many schemes, so we are working on that piece. It builds ownership of the achievement of outcomes and accountability for observance of the principles. And since it's a collaborative effort, so the ownership is also there. That's another advantage of having this approach. And one illustration which I would like to point out is on the institutional mechanism to check front running and other fraudulent practices. We've had a lot of engagement with MFI and we asked their proposal, we refined it, again, many iterations between us. And now we have some feedback once it has been put in practice, and we are looking at it, how we can further simplify that or how further improve it without compromising on the market integrity issues. So again, just to re-emphasize, compliance in itself is necessary. I'm not trying to underplay the significance of compliance, but it is not an end in itself, but it is a means to achieve the desired outcomes in the market. So just last slide, I guess, some takeaways. See, it's a big topic, and we can just go on discussing and talking about it for a long time, but in the context of what I mentioned, what are the key takeaways? I think we need to avoid short-termism. We need to focus on building long-term. Sorry, I'm pontificating here, but this is something, these are mantras which we need to remind ourselves off and on. So we need to focus on building long-term investor value. We need to build trust through transparency and simplicity. Keep the things simple. Again, going back to too many schemes or too much jargon and so on. Beware of the slippery slope. Seemingly small compromises can snowball into bigger issues. And, I looked up at what Mr. Raju, when Satyam happened, he wrote in his letter to the board, and all of you know this was a big fraud of about 7,000 crores, involved fake invoices, inflated revenues, non-existent bank balances, understated liabilities. So what Mr. Ramalinga Raju explained, he explained how an initial cover-up for poor performance escalated. And I'll just read out, it is from his letter. So he says, what started as a marginal gap between actual operating profit and the one reflected in the books continued to grow over the years. It has attained unmanageable proportions as the size of the company's operations grew over the years. Then he also says, which became a very famous quote, it was like riding a tiger, not knowing how to get off without being eaten. There's more to it, but I'll pause with that. So the point is, any slippery slope has to be arrested in time, has to be dealt with effectively in time before it becomes too big to handle. Next bullet is more for distributors or the sales people of AMCs. Apply the family test. Ask yourself whether you would be doing and saying exactly the same thing if your family member was the investor. That's the true test, and it's very simple, right? It's basically facing the mirror. So, mere lip service to ethical conduct, as I said, you may have very fantastic, and today AI tools can give you, you don't even have to, they can give you a fantastic statement to keep, and they can design the framework. But what matters here is the implementation. You have to walk the talk. Just the talk and having statements is not good enough. You must, of course, I would ideally like every AMC to say that we believe in strong ethical behavior in our company. Make a public statement. But don't just leave it at that. You should have very studied framework below that statement in terms of various tools, various mechanisms, various frameworks to achieve that goal. And you should be able to demonstrate that. That's what my next point is. Demonstrate evidence of commitment to fair and ethical behavior, to inspire trust of regulators and other stakeholders. We can sleep easy. You know, if there's an evidence of commitment to fair and ethical behavior, it becomes, you know, we are preparing ourselves for more principle-based regime than a very granular rule-based regime. I will pause with that. Thank you very much. You've been very patient with me. Thank you.
Stay on for a couple of minutes. I'm sorry, we didn't really anticipate that you would ask, want to ask a question to people on the dais. It's usually the other way down. But a couple of remarks we should get, because that's a vitally important point that you raised, that are there enough investment opportunities to handle the kind of flows that we are saying? And we are saying that we want to expand the investor base even more. So one CEO and one CIO should take this question.
So you're not happy with all the questions you asked, but I think your point is valid, and there are pockets like we keep debating the mid-cap space of 150 stocks where so much of money is going and temporarily creating pockets of fraud. But at large, like I said, what I'm very happy about is the large growth of hybrid funds, asset allocation funds, which has equities, fixed income, gold and silver, and global stocks. And between these four, we can get the next 5 lakh crores also. REITs has started, but of course, REITs, the ecosystem also has to develop in terms of many more credible options to absorb retail money. So I think for now, I feel that the flows that we are getting is reasonable enough in terms of the asset liability match, barring these pockets of internally in our ranking, we feel the mid-cap space is where the froth is more. Small caps we are comfortable, large caps we are comfortable. It is because this mid-cap is a very sweet spot. Large caps also put their money there. Small cap guys also put their money there from all categories in this 150 stock. So some thought around how to manage that, hard limit of 150 stocks to a certain extent. I don't know, but better guys to.
Same, I completely echo, because if you look at the ownership in the top 100 companies, I think we have a long way to go. A small cap, the universe is expanding because we have large number of new companies getting listed. I think that 150 needs reconsideration. With time, that should have expanded. I think that needs to expand.
Sure.
And just one point, sir, that the global space is useful for investor outcomes, but right now the limits are shut. And I know SEBI has been also trying to working with RBI. So that can again, give a reasonable pressure cooker relief.
Just to sort of supplement, so what, Navneet, what you mentioned, so we would like to see more self-restraint in the sense, he explained about stopping flows into a particular scheme. And as a regulator, I cannot do that. It's a free market, right? And I should not do that. I'm not controlling here. So if the industry does that sort of self-restraint, I'll not accept beyond certain amount, or I'll keep it open only for a short time, and because of good reasons. And you explain those reasons. I think that kind of behavior will really inspire more confidence. Thank you.
So one question for you that, what are you as a regulator going to be able to do? For example, the question that I posed to them, that we need to expand beyond equities and debt. What is it that you could do as a regulator to expand the canvas of mutual funds into real estate, making things easy for them to come under the MF framework?
Sure. So we are, regularly thinking about these things, and maybe just to give you an example on the real estate side. So now we are considering, we did a consultation also on that. Can we increase the limits for investment into REITs and InvITs? Not only that, we are even looking at, today you have flexibility of treating investment into REITs as equity, debt, or hybrid. So we are looking, can we make it equity? And there is a divided house. We just treat it as equity as it is done globally. If you do it, if you classify it as equity, a lot of passive money can come in, and that will create some, I mean, there are arguments on both sides, but these are the issues that we keep discussing and debating. Definitely we are, as I said, we are paid to worry, so you don't have to worry.
Thank you. Thank you so much, sir.
Thank you so much, Mr. Singh, for that insightful and thought-provoking address, and also the opportunity for others to ask you questions. Thanks a lot. Well, moving on to the next segment of this evening, ladies and gentlemen, as India's growth story gathers pace and equity valuations remain high, investors are faced with a crucial question. Where does the next big opportunity lie? Do you stay with the ongoing investment-led cycle, or is it time to position for a consumption rebound after a period of underperformance? Our next discussion will unpack the risk-reward dynamics of two key themes: investment versus consumption, exploring sectoral trends, valuation comfort, earnings momentum, and the macro risks shaping investor sentiment. To moderate this important conversation, please welcome back on stage N. Mahalakshmi, and joining her for this discussion are our esteemed panelists, Ashish Gupta, CIO Axis Mutual Fund, Rajiv Thakkar, CIO and Director PPFAS Asset Management, Nilesh Surana, CIO Mirae Asset Investment Managers India, and Sri Datta Bhandwaldar, Head Equities, Canara Robeco AMC. Let's welcome them with a huge round of applause.
Thank you, Nandita. Of course, this is also a vitally important discussion. I mean, everybody in the end wants to know what are the stocks and sectors and themes that are going to make money, right? And where do you invest, whether you're a stock investor or a fund investor. And I think one thing is really settled, which is, again, a message that has been going out from almost all fund managers, at least over the last 1 year, that, you know, the markets are getting tougher. The alpha opportunities are reducing, and the post-COVID phase, the first 3 to 4 years that we saw of very solid returns is not going to be replicated. We'll have to focus on stock specifics, fundamentals, pockets, and even within sectors, you have to be very choosy about which stocks you invest in. That is settled, but the interesting thing about the four gentlemen out here and why I'm excited about the panel is each one has a slightly different style of investing. They're postured differently. They have, therefore their views can be quite different, and we'll try to assimilate their views and their logic so everyone can take away whatever they are most convinced about. So thank you so much, gentlemen. So the first question is, there are three broad categories in markets, the way we've understood it: the consumption theme, the investment theme, the China plus one theme. But today we can talk about all three. But the big question that people have been asking is that, is a consumption revival, is consumption going to lead the charge in the next round? Is that where we are going to make our money? Because investment phase has sort of done the heavy lifting over the last, in the post-COVID period, especially because we were in an investment upcycle also triggered by huge spending by the government. Is that, in a sense, likely to get swapped in this phase? Sri Datta.
Good evening, everyone. I think it's an interesting question. Most of the time we try to answer questions in black and white. My answer is in between, actually. It's going to be barbell, that's how we are looking at it. But having said this, on this barbell, I think both sides, whether it is investment side or consumption side, there are certain clear-cut trends that are visible. And as you rightly said, and I largely concur with that, that if you look at not only last actually 4 years, but if you take last 10 years, effectively, predominant focus both from central and state governments and then real estate joined the party, which are the three critical components of CapEx, have been on the positive side. In fact, the growth in these three categories, if you take 5 years, has been upwards of 13-14% CAGR. Even if you take 10 years, it's actually roughly 10-11%, which is a little bit higher than nominal GDP growth rate. And that clearly propelled the kind of rally that you have seen on the investment side, because to start with, they had gone through the underperformance of the entire last decade, because balance sheet, we started the last decade with leverage. And that's where there were a lot of challenges, both on banking and manufacturing side. And as you came out of that, you got both the earnings re-rating, driven by all three components. And in fact, private capex was also healthy for 2 years, calendar year 22 and 23 particularly. All four components were firing. And so you got a growth which was clearly above average. Now, having said this, does it mean that you're likely to see a substantial slowdown? Our sense is it is just going to be moderation. And incrementally on investment side, clearly you have to actually opt for pockets where either for geopolitical reason, which is some of the defense, aerospace, and some of the areas where probably opportunities will continue to expand. So you have to continue to look at them, not necessarily the same stocks, same spaces, but that one you have to continue to look at. Clearly transmission and distribution is a space which you have to continue to look at, given how the power sector dynamics is changing. You would also continue to look at renewable power itself. Now, you can choose, pick and choose the part of the value chain that you want to play, but you have to continue to look at. So, incrementally, yes, the margin of safety on the investment side has gone down. Incrementally, there is a moderation, except for private capex, which we are expecting that at some point in time will kick in. But clearly, public capex has kind of plateaued, mostly probably run at 8 to 10% CAGR over next 2-3 years. And when I look at all these three things, on the investment side, clearly we would want to be placed in a space where the profit pools are expanding and there is a high visibility. And those are the three spaces where I clearly see that, okay, both these criteria are getting met. So that's the investment part. When I actually start looking at the consumption side, I think clearly when you again look at what are the key drivers for consumption? Actually, the key two drivers for consumption fundamentally are, of course, one is job growth rate, wage growth, and third is whether we like it or not. Again, Indian basically economy is structured in such a way that again governments play a very, very critical role. I'll again step back and say, when you look at the revenue expenditure of state central government put together versus the capital expenditure of state central government put together, this regime over last 10 years has chosen predominantly the investment side or fixing the supply side versus the consumption side. And that's where the revenue expenditure generally has been lower, which has also been one of the factors apart from subpar job growth, which has led to mass consumption. Again, when we talk about consumption, it's the mass consumption which has suffered, not the luxury consumption. Our sense is incrementally the redistribution of government resources has started tweaking towards the basically mass consumption, towards the revenue expenditure. If I have to quote the few, the social schemes put together, state governments 3.2 lakh crore rupees, central government tax cut of effectively 1 lakh crore rupees. You have GST cess, which will go out, the obligation will go out in 2027, which will be available money for central government to spend towards consumption, the liquidity, the interest rate cuts. So when I actually combine, and wealth effect through gold, when I combine a lot of these factors, and when I look at the expectations on consumption side, particularly mass consumption, I'm again and again actually addressing that point. In terms of the statistical valuation might be a little expensive, but from an expectation perspective, from a